Welcome to another episode of Founders Insights. Today I want to talk about co-investments and the importance of them for investors. Once an investor becomes a bit more savvy in joint ventures or passive investments, they often will ask the sponsor that they're thinking about investing with about what their co-investment is. And what that means is they want to know how much the sponsor is putting into the deal of their own money. It sounds simple, but it actually gets a lot more complicated because in these structured investments, a sponsor is often entitled to upfront fees as well. So investors will also wonder, okay, well, what is your investment net of your fees? Because they're looking at, well, if you're earning a $500,000 fee and you're investing $500,000, are you really investing into the project? So there's all these nuances and negotiations, and things can get messy. And I'm here to tell you that it's even messier than you think, because what is a co-investment of 5% of the deal or 10% of the deal to one sponsor could mean a world of difference to another sponsor. And what I mean by that is I sometimes get frustrated when an investor demands a sponsor to co-invest 10%, because while I think that's a decent rule of thumb, that also could be missing the point of where is that sponsor in their journey of growing their business. For example, if a sponsor is younger in their career and they don't have as much capital in the bank, then a co-investment of 10% on, let's say, a $20 million equity raise, so a $2 million co-invest, that could be pretty unreachable for that sponsor. And you wouldn't want to miss out as an investor into a good deal if you're going to walk away because the sponsor isn't investing that classic 10%, which would be $2 million in that case. Another thing that muddies the water here or can be fraught is, do you really want that sponsor to put $2 million into that deal when they could use that $2 million to grow their business? We are a sponsor ourselves, and we have a lot of capital needs as we look to grow our business. With every unit and every property that we add to our portfolio, we look to hire additional regional managers and other asset managers in ways that we can help run the properties that we're investing in better. So do you just want the sponsor to invest in the deal and hope for the best, or do you want them to be investing in ensuring that that investment pays off? So those are all just a few nuances that go along with co-investments. And a conversation that we've been having recently on the flagship podcast, the Lone Star Capital podcast, with some of our esteemed guests is about this co-investment. And it's refreshing to speak with more understanding or nuanced capital partners who go, hey, look, I'm not just going to blindly require a 10% co-invest. If $100,000 is meaningful to that sponsor, I know I'm going to get great commitment out of them. I mean, if you talk about a sponsor doing their second, third, or fourth deal and they have no round trips yet, and they're willing to put $100,000 into that deal, and that's their only $100,000, you can better believe that they're going to have way more buy-in than a sponsor who's had many exits and has a net worth of $50 million, and they're going to co-invest $1 million into the deal, right? You can imagine which sponsor has more buy-in. There's also this notion that reputation and reputational risk trumps co-investment dollars. And what I mean by that is similar to what I just alluded to as far as a emerging manager versus a more seasoned manager, where an emerging manager with a limited track record and a limited amount of exits is, generally speaking, more motivated to ensure the success of a deal because they can't afford to have a deal go poorly. Irrespective of the economic outcome of the deal, reputationally, they can't afford the deal to go bad because they only have 2-3 deals in the portfolio, right? You can't have one bad apple in a basket of 3. But if you're a tenured sponsor who's done 50 deals and you have one deal that you lose investor capital on, you can live to fight another day. That's not going to put you out of business. So I'm not saying one is better than the other. There's obviously pros and cons with working with younger emerging managers versus tenured seasoned managers, but those are things to consider as you're tying together kind of the reputational co-investment, if you will, as well as hard dollar co-investment, if you will. One thing also that I think is super compelling and not nearly often talked enough about, and something I'm very proud of here at Lone Star Capital, is how substantial our employee investment is at the firm. What I mean is employees across the firm here in New York, as well as our on-site property management and construction management teams down in Houston, invest heavily into our projects themselves. I think this speaks volumes, almost above and beyond, really honestly, actually above and beyond principal co-invest. Because as a principal, you're the founder of the company, it's your baby, of course you're bought in, of course you need to put money into your own deals. But if you as a sponsor, as a principal of the company, have a successful enough of a strategy and have put together a strong enough team where they all believe in the strategy enough to invest their own money and a part of their paycheck into the deal, I feel like that's an even stronger vote of confidence for the deal. Similarly, if you're talking about Brad Oliver, our director of acquisitions, nobody's closer to the deals and closer to the numbers than him. So if he's willing to co-invest into the deal, that is an even stronger vote of confidence than me, for example, right? Because he's day in and day out underwriting deals and talking with brokers, and he knows the market really well. So he can sniff out whether a deal is a needle in a haystack or just another deal being marketed out into the market, right? So those are things to consider also. And I'm not telling you to then go and ask every sponsor that you're looking to invest with, hey, what's your employee co-investment? That might be intrusive or not market, but I think we're pretty transparent, and we certainly would be open and willing and honest. And for example, if you've worked with us before, you certainly know our director of business development, Craig McGrother. He co-invests heavily into the deals, and I'm sure he's an open book. So if you're on the phone with him and you want to ask what he thinks about the deal, and if he's personally investing money into the deal, go ahead and ask him and see what he says. And, he'll be honest with you and maybe let you know, hey, I think this is a good deal, but we have a deal around the corner that I think might even be better. So it's a huge vote of confidence where we have partners, employees at the company like Craig, who have a majority of their net worth in Lone Star investments. If you found this information interesting and helpful, please share it with a friend. Please like and subscribe. And we'd love to get in touch with you if you'd like to learn more about investing with us here at Lone Star Capital.